Hello, my name is Darren Jones. Thanks for tuning in today. What I'm going to talk to you about today is international portfolio bonds and particularly the tax treatment of them in the hands of a UK resident individual. So if we first of all have a look at the mechanics of how these products work, essentially what you buy is a contract, technically a contract of insurance with a provider in a very tax efficient location like the Isle of Man, possibly Guernsey, Dublin, Luxembourg, Mauritius, places like that. So well regulated jurisdictions, but in a very tax efficient place. We typically use the Isle of Man, which is where most providers are, often Guernsey and occasionally Dublin as well. So essentially what you're buying into, as I say, is a contract of insurance. Now within that contract of insurance, you have various underlying investments. So as far as a client is concerned, they're investing into things like direct equities, mutual funds, structured products, maybe cash on deposit, index trackers. But actually, they are not. Technically, what's happening is they're buying the contract of insurance, and then the provider of the international portfolio bond is investing in those assets that I mentioned that the client's overall investment value is reliant on. So the value of the big circle on the screen in front of you is actually all of the little circles added together, but technically what the client owns is the contract, the big circle. So as you buy and sell and trade assets, hopefully it grows in value. So as the investment grows in value, you would normally expect that the individual would need to put that on a tax return and pay tax on it, but not so when you do so via the international portfolio bond. The logic being what you own is still the same, and therefore this concept of gross roll-up or gross returns applies. And that's the first tax benefit. So as you generate income in the form of dividends or interest or coupon, there is no need to disclose that on a tax return if you are living in a place like the UK. And also, as you trade funds and realize capital gains, there's no need to disclose that on a tax return, let alone pay tax on it to HMRC in the UK. So gross roll-up is the first benefit of one of these products. We then need to consider the 5% withdrawals and this concept of time apportionment relief. So let's do that by way of an example. So let's assume, first of all, example one on the left-hand side, you invest £100,000 into an international portfolio bond. Over a 10-year period, no withdrawals are taken, and that grows, let's say, doubles in value to £200,000. The profit clearly is £100,000. And if you were to cash that in 10 years' time, as a UK resident, that's potentially liable to UK taxes. On the right-hand side, however, we make withdrawals along the way. So we have an option within the international portfolio bond, part of the legislation in the UK, to take up to 5% of the original principal invested each year with no need to disclose it on a tax return or pay tax on it. The logic being it is pointed as a withdrawal from your original principal, not the profit that's been achieved along the way. Okay, so let's assume that the 100 is invested, the same as example one, but this time we make a 5% withdrawal every year. We do so for 10 years, so we've had £50,000 back. So now the value in year 10, ignoring the effect of compounding, would be 150,000, not 200,000. However, the profit is still the same. And the logic being that's because you have been making withdrawals of 5% a year from original principal, which is now reduced to £50,000. The profit on which going up to 150,000 is therefore still £100,000. So the tax deferred withdrawals, as they're called, are called such because what you're actually doing is you're taking back your own money. So clearly that's tax-free. And then because you're taking back your own money, all of the growth is accumulating in the tax-efficient environment of the offshore portfolio bond. And then when you come to finally surrender it in, say, 10 years' time, that's when there may be a tax position. So they're known as tax deferred withdrawals. You're kicking the can down the road and you're likely to pay tax later if you're still a UK resident at the time. But one additional advantage is that you also get something called time apportionment relief. So let's just change the example slightly. Let's assume that you invested over that 10-year period, 6 of which you were a non-resident and 4 of which you were a UK resident. Now this changes the tax position on final surrender because whilst the profit is £100,000, you only pay tax on 4/10 of that, i.e. the proportion of time that you are a UK resident. They actually calculate it on a daily basis. So if you'd spent 4 years there, you'd have had 4 times 365 days in the UK, and you would divide, that would be the numerator, the denominator then would be 10 years, 3,650 days, multiply that by the profit, and you come up, in this example, with £40,000 potentially taxable. So that's the effective time apportionment relief. It gives you a direct credit for the number of days you are non-resident throughout the investment period. It completely removes the stress of repatriation to the UK. Absolutely no need to cash in the investment in, for example, a tax year before you move to the UK, because you have automatically accrued benefit or credits for the period you are living offshore. Let's extend that out now over a longer period of time. So let's say 20 years. On the left-hand side, the 100,000 has doubled in 10 years, doubled again over 20 years. The profit now is 300,000. On the right-hand side, we've made withdrawals of 5% per annum for the whole 20 years. So now we've had our whole £100,000 back as tax-deferred withdrawals, leaving the same profit, the £300,000, in the overseas environment in a very tax-efficient place. But now, of course, the original principal value that's left in our investment is zero. So all of the value that's in there must be profit. If we continue to take 5% a year beyond year 20 into year 21 and beyond, now we're going to have to put that on our tax return and pay tax on it. But we still get time apportionment relief. So just in the same way that we were given credit for the 6 years of non-residency in the previous example, so are we here. But this time, because we've invested in total for 20 years, the fraction is somewhat different. 300,000 is the profit, 14/20ths of which is taxable, so £210,000. And that looks pretty horrible, and it's taxed at our marginal rate of income tax. But actually, it's not as bad as you might expect, because the next benefit of the international portfolio bond is this thing called top slicing, or an averaging, think of it, over a period of time that you're a UK resident. So here the gain is 210,000. 14 of those years were spent as a UK resident, which gives us an average gain per year of £15,000. And that £15,000 is the number that is added to your taxable income in the UK in the year of encashment to dictate what rate of tax you're paying. So by way of example, currently, let's assume the higher rate of tax in the UK kicks in at 50,000 sterling. Let's say our taxable income in that particular year is, say, 20,000 sterling. So we add the 15,000 to 20, we get 35. That's still way below our higher rate tax threshold. So whilst the whole £210,000 is taxable, it's only at our basic rate of income tax, currently 20% in the UK. So you would pay 20% of 210,000, £42,000 in tax. Now, bearing in mind on the previous slide here, we had £300,000 worth of profit. To have a taxable amount of £42,000 is not at all bad. That's a 14% essentially tax rate in that year of surrender. So we've had gross roll up along the way. We've paid no tax on our income. We've paid no tax on our gains. We've been able to withdraw 5% a year in what looks like income to us as UK residents. We then get relief when there is eventually a tax liability for the period we're a non-resident. We get an averaging effect over the number of years that we were UK resident to help maintain the lower rate of tax. And finally, our two final points, you're able to assign ownership of these vehicles to the most efficient taxpayer. So for example, if you have a husband and wife and maybe adult children, you can choose either to assign, for example, from husband to wife if the wife is a lesser rate taxpayer, or if you wish, you can assign some or indeed all of the investment to your children who may be perhaps university students, or maybe they live outside of the UK. If you want to make them a gift, you would not surrender the investment yourself and pay UK tax on it. You would assign some or all of it to them. They would cash it in. They would be the taxpayers. They would make use of their own UK personal allowances, for example, if they were studying at university. And then the final advantage is these things are incredibly easy to wrap inside of a trust. As you'll see in one of the other videos that I've recorded, we have various mechanisms, particularly for UK domicile people, where they can use a trust for inheritance tax advantage. And these vehicles are incredibly easy to hold inside trust, whether that's for tax purposes or possibly just for succession planning or indeed asset protection reasons. We have put together a series of guides, particularly relating to portfolio bonds and the treatment for UK residents. As you can see on the screen there, we have one called a guide for a discounted gift trust, which is a UK inheritance tax plan. We have a repatriation guide. We have a guide on what we're talking about today, which is international portfolio bonds and the general tax benefits. And also for those that are non-domiciled, we have an excluded property trust guide. We're building on this list of guides on a regular basis. So please see the portal and you'll see all the PDFs there with the guides included for download. Okay, I hope you found that useful. Short video on the tax treatment of international portfolio bonds for UK residents of the future. Thanks very much indeed for listening today.